Hi, welcome to Chapter 6, Efficient Diversification. This is part of a series of chapters that discuss portfolio theory. Now, let's think first about portfolio objectives. Setting portfolio objectives involves trade-offs, of course, such as the trade-off between risk and return or between potential price appreciation and income. How investors evaluate these trade-offs depend on their tax bracket, income needs, risk tolerance, age. One objective that should appeal to every investor is to establish an efficient portfolio. So when we say efficient portfolio, we're talking about one that provides the highest return at a given risk level. So efficient portfolios aren't necessarily easy to identify. Investors usually search out investment alternatives to get the best combinations of risk and return. So a lot of what we're talking about in this chapter is going to be tied to this efficient portfolio. So when we talk about portfolio returns and standard deviation, something we introduced standard deviation last chapter, we can apply that to portfolios. So the first step in forming a portfolio is to analyze the characteristics of the securities that an investor might include in the portfolio. So two of the most important characteristics, of course, is to examine the returns that each asset might be expected to earn and the uncertainty surrounding those returns, or those expected returns. As a starting point, we will examine historical data and see what returns stocks have earned in the past and how much of these returns have fluctuated to get a feel for what the future might hold. This is a lot of what we did last chapter, looking at standard deviation, returns over a period, but now we can apply those concepts to a portfolio. So the portfolio return is just a weighted average of returns of assets inside the portfolio. So the portfolio return depends on the returns of each asset as a part of a whole. So each asset would be a weighted part of the total return. So we can call that like a fractional invested amount of money in each asset, and a portfolio weight is going to be what percentage that asset is of the total portfolio. So if we take the sum of the weights and we multiply it by the rates, and we can find what the weighted average of a portfolio would be. And then to move it one step further, we can dissect portfolios by pulling apart different stocks and recombining them and reapplying this analysis of standard deviation for different groupings of stock within a portfolio. If we look at two companies as part of a portfolio, and then we want to maybe look at what would be the best weight for each stock, 10-90, 80-20, 50-50. So we need to decide the weights that each stock should receive in the portfolio, and we want to assume that by testing out different weight combinations, maybe we would come to a more efficient portfolio that's going to return the highest return at the lowest risk. So that's really the goal of managing a portfolio's risk. So we want to examine the risk of different portfolios. So measuring each stock's individual risk is the first step of doing that. So recall that one measure of risk is the standard deviation of returns. So we can apply that standard deviation, as we talked about last chapter, in calculating a portfolio return or a standard deviation for a portfolio, which is a pretty cool concept, and we'll see more of that later. So let's just talk about correlation, diversification, and beta. These are all very core concepts to this chapter and to portfolio theory. So, and because they all center around portfolio risk. So a lot of what portfolio theory is managing the risks of groupings of different assets. Now, diversification means including different investments in a portfolio, of course. And it's a necessary step in creating an efficient portfolio, because if everything's too similar, the risks become too great. So the statistical concept of correlation drives the benefits of diversification. So an efficient portfolio planning is going to require understanding of how correlation and diversifications influence any particular portfolio's risk. So correlation, this is another statistical measure like standard deviation, but correlation is the measure of a relationship between two series of numbers. So if two series tend to move in the same direction, they are positively correlated. So for example, if two people were handcuffed, they would be positively correlated. So wherever one person was, the other person is. Now, if two series of trends or indicators move in opposite directions, they're negatively correlated. So think of two people who live on opposite sides of the earth. So these two people would never be together. They would be perfectly negatively correlated. For another example, if each day we record the hours of sunshine and the amount of rainfall, we'd expect that these two series to display some negative correlation because rainfall tends to happen when it's cloudy days. All right. So finally, if the two series bear no relationship to each other, they would be considered uncorrelated. And we would probably expect no correlation between the hours of sunshine on a particular day and the change in the value of the US dollar. So there would be no obvious correlation between the two. Although, interestingly enough, they have done some analysis of stock market returns and focusing on sunny weather and rainy weather in New York. And they interestingly enough found that stocks go down more often when it's raining in New York than when it's sunny. Just something I thought I'd add here. How ridiculous things that should seem like they're very uncorrelated sometimes do have some sort of correlation, whether there's a direct tie to it or not. So correlation doesn't always explain why they're correlated. It just shows mathematically if they're correlated. So they don't really produce a reason why. So the degree of correlation, whether negative or positive, is a measure of the correlation coefficient. So which is represented by it's something that it's actually pretty easy to calculate in Excel. So they have a correlation coefficient function that you could use in Excel that you could easily, it's called Corel, it's easily to use to find the correlation between two series of numbers, and we'll investigate that later. Now, diversification, I'm sure you have the basics of this concept. The general rule is the lower the correlation between any two assets, the greater the risk reduction that the investors can achieve in combining the two assets in a portfolio. So by tracking the performance of two different assets as a pair of securities, we can get this idea of how well correlated or not correlated they are. So we could look at, say, two energy companies that operate in electric and gas. Because their core businesses are so similar, these stocks, you'd expect to see a high positive correlation. Now, so that's generally true of companies that are within the same industry and make the same product. They can have a high level of correlation, but not perfectly correlated. Now, diversification of buying more stocks in the same industry is not going to reduce risk if all the portfolios are roughly have the same volatility and the same return aspects. So that's why when you want to diversify with different companies in different industries, different products, different mix. So let's move over to and talk a little bit about beta. So, and keep in mind too, international diversification has an effect on enhancing diversification as well. If you're buying companies in different parts of the world with different market aspects, that's an important thing to think about too. Let's just see. Okay. Let's just talk about beta for a minute. So beta is a measure of undiversifiable risk, something we're going to talk about in a second. But so estimating an investment's expected return is going to require measuring its risks. So risk has two components. the systematic and non-systematic risk, which we're going to talk about more in a little bit. So beta can measure this undiversifiable risk, and it's going to indicate a security's return related to a market. So the sensitivity of the security to the market, and that's why it's related to correlation, because beta coefficient is sort of a correlation of your stock and its movement as compared to the market. Now, if we want to estimate beta, we have to
gather historical returns, look at a specific stock, and for the overall market, we want to include that stock in. So when we speak of returns in the overall market, it's the market closest to where the stock would be associated with. So if it's a large U.S. firm, we might associate it with the S&P 500. It should be a broad portfolio of stocks, like the S&P 500 is a good example. And we can plot these stocks on a graph or the market return on the x-axis and the stock's return on the y-axis, and we can produce a slope of the trend line going through the resulting points that helps us to estimate beta stock. So beta stock is really the slope of the stock on this chart. So we could use data points to plot it on Excel to insert a trend line, which we'd call a characteristic line that best going to fit the coordinates of the stock, and then we could use that to develop the slope to figure out the amount of incline in the stock. So if we're going to interpret beta, by definition, beta's, I would say, the overall risk of the market is 1. So a beta of a stock is going to be something larger or smaller than 1. So if the stock is exactly identical in movements to the market, it would have a beta of 1, which is very rare. So if a stock has a beta of, say, 2, then it's going to be twice as reactive of the market moving in the same direction as the market. So that basically means if the market goes up 10%, your stock will go up 20%. If the market goes down 10%, your stock will go down 20%. And if the beta was a negative 2, stock market went up 10%, your stock would go statistically down 20%. If the stock market went down 10%, your stock would go up 20% with a negative beta. So we can investors can use beta to assess an investment's risk and understand the impact that the market can have on the returns. So here's just some important points about beta to think about. Beta is the measure of the undiversifiable, or what we call systematic risk. Beta for the market as a whole and for the average stock should be close to 1. So the market should be 1, and most stocks are going to be close to 1. So in theory, stocks going to have positive and negative betas, but most stocks are going to have positive betas greater than 1. Because the market is more smoothed out because it has the most amount of points of variation within it. So stocks and betas greater than 1 are more responsive than the market, or the averages, and they're going to fluctuate more aggressively and thereby be riskier. So the higher the beta, the greater the risk in the market. Let's talk about the components of risk. So investment risk has 2 components: diversifiable and undiversifiable risk. So diversifiable risk is sometimes called unsystematic risk, specific firm risk, unique risk, or you get the picture. So the results from factors that affect a single firm or perhaps a handful of firms, such as whether a new product succeeds or fails, the performance of senior management, the firm's relationship with its customers and suppliers. So unsystematic risk is a portion of an individual's risk or an investment's risk that diversification can eliminate. So let's just think about this for a minute. Diversifiable risk, or what's known as unsystematic risk, means that it's specific to a firm. So owning more firms within a portfolio can help eliminate the risk of any one company.
So if you had a portfolio of, say, fast food companies, you could mitigate the risk that one food company may have a problem with foodborne illnesses. So you could have a company that is making people sick. So that's going to really devastate the stock price. So owning just that company, you're going to face the maximum amount of risk. But if you had that as just 10% of your portfolio, or owning 10 different fast food types of companies, you can see how that's going to mitigate your risks. However, having a portfolio of all fast food companies is not well diversified, because there are some diversified risks that they may all face, which it could be changing tastes and people preferring to eat healthier foods. So building a portfolio of many different companies in many different industries would be optimal diversification. But there's still another type of risk we have to worry about, called undiversifiable risk, or what's sometimes called systematic risk or market risk. So this is the inescapable portion of investment risk that's going to remain in portfolio. Even a well diversifiable portfolio is going to have this market risk. So it's risk that you really can't escape by buying more different stocks in a portfolio. So this systematic risk, or we call market risk or undiversifiable risk, is associated with these broad factors such as economic growth, inflation, interest rates, political events, world medical events, world weather events that are going to affect nearly all investments, and thereby are not unique to any single investment. So the sum of undiversifiable risk and diversifiable risk is what we call total risk. So any careful investor can reduce or eliminate this diversifiable risk by holding a diversified portfolio of securities, right? So studying diversification and carefully selecting your assets in your portfolio is not that difficult of a task. But studies have shown that you don't really need that many stocks to eliminate this market risk. So owning at least 12 to 30 stocks will eliminate most of this diversifiable risk. Now, so that's good news for investors. There's a way to control at least one of the two aspects of total risk. But in investors who fail to diversify are simply going to bear more risk than they need to for their return. So diversification is one of the cornerstones of portfolio theory. How do you effectively diversify, and what the effects of that are going to be, and what's the most efficient portfolio to build, to eliminate as much much of this risk as possible. Okay, so let's talk about some modern portfolio theory. So in the 50s sometimes, this Nobel Prize winner, Harry Markowitz, developed a theory that formed the basis of what we call MPT, modern portfolio theory. So in years since this pioneering work, many other scholars and investment experts have contributed to the theory. So modern portfolio theory uses several statistical measures to develop a portfolio plan. So portfolios using the modern portfolio theory principles estimate the average returns, standard deviations, correlations among the combinations of investments in any optimal portfolio, or to find an optimal portfolio. So according to the MPT, the maximum benefits of diversification occur when investors find securities that are relatively uncorrelated and put those securities together in a portfolio. The one thing that is a big aspect of this modern portfolio theory is efficient frontiers and portfolio betas. So, although we're going to talk about this more later, let's introduce the efficient frontier concept. So investors have thousands of investments to choose from. So by selecting different combinations of these investments, they can form an almost unlimited number of portfolios. So if we could calculate risk and return for each portfolio, plot each of these
risk return combinations on a graph, then we would have a set of portfolios, some feasible, some maybe unattainable, but certainly some that would be attainable and would be feasible. And this is going to represent a shaded area. And this, an efficient portfolio is what's going to exist to provide the highest return at any given level of risk. So when we look at this efficient frontier, there's going to be a boundary on the outset of the frontier that's going to be the most efficient. So if we look at the upward sloping part of the boundaries of the feasible set of portfolios, they're going to represent all efficient portfolios. Those portfolios that provide the highest return for each risk level are going to form the boundary of this area, that's what we call the efficient frontier. So every portfolio to the right or below this efficient frontier is going to be less efficient. So portfolios that, how can I say this? A portfolio that is on the efficient frontier is going to dominate or be the best example of all the portfolios that are being analyzed. So it's really to say, let's put all these portfolios together and then see which ones come out on top. And that's how we formulate the efficient frontier. So, for example, anyone would love to buy an investment with an extremely high return with no risk, but there's no such investment exists. So we can, in theory, use the efficient frontier to find the highest level of satisfaction the investor can achieve given the available set of portfolios at their disposal. So now, when you do build a portfolio, we talked about beta before, you can use beta to measure the reactivity of the portfolio, but also to see, you can make a weighted beta of a portfolio to get a better idea of the variety of risk within the portfolio. So creating a weighted beta for a portfolio can give us a way to measure portfolios against each other. So the portfolios with the higher betas would constitute portfolios with higher risk. So because diversified risk is easy to eliminate, the market provides no reward for bearing this type of risk. So it's important to understand which beta is a measure of this risk, what the extent the risk that's diversifiable is going to be inside the portfolio. So that's why we might want to look at these of the portfolio, what the portfolio risk would be is measured by beta. Okay, so let's look at this slide a little bit more closely. Okay, so in the first portion here, we have a firm-specific risk only. So this would just be the firm's risk, and we have the standard deviation, which measures the dispersion, and then we have this would be the number of assets. So this would just be one firm. But if we're going to measure, picture this line N as we're picking up 1, 2, 3, 4, 5, 6, all the way up to say 30 stocks. So over here would be 30, over here would be one stock. Now that market risk, that non-diversifiable risk, no matter how many stocks you put in your portfolio, this measure of risk here is not going to change, it will remain constant. But the diversifiable risk, we could see that as you're adding more stocks into your portfolio, this risk measured from starting at the market risk to the blue bar is maximized at 1. That's the maximum level of risk. And then you can minimize this risk as you add more stocks into your portfolio. You can't eliminate all of the diversifiable risk, but you can eliminate a significant amount of it by including building a well constructed portfolio of firms with lower correlations. Okay. So portfolio risk decreases as diversification increases. So we could look at, this is again, those number of stocks I was talking about versus the standard deviation. So the standard deviation percent will be quite high for 1, 2, 3, 4 stocks. But as you start including stocks, you start to minimize this risk. Okay, so covariance and correlation. Portfolio risk depends on covariance between the return of the assets. So this is something we were talking about earlier. So if we expect the return on 2 securities in a portfolio, this is the basic formula that we can how to calculate expected return when you have 2 assets in a portfolio. Okay. Now, as far as correlation calculations, we have formulas on the correlation calculation and the correlation coefficient. So the correlation coefficient is a numerical number to measure the correlation. Okay, so if we look at capital market expectations, so here is a series of outtakes from a spreadsheet that I'm going to review later in a separate video. But we could look at again, should look familiar from a little bit from last chapter, and we're calculating the expected or average returns. So if we have different scenarios of economic conditions, probabilities of occurrence, and the rate of return for a stock fund, multiplying columns B and C together, we can find the sum to calculate the mean. And if we look at a bond fund and we do something similar, we could see that the expected or mean return is lower for a bond fund than a stock fund. So there, if we move forward and we add to that, I go backwards here. Okay, we could add to that a standard deviation. So we could take that same, this is using, if you see here, they're using the same numbers, but now we're going to complete the standard deviation by calculating the variance and then the standard deviation for a stock fund and a bond fund. And we can see that the variance and the standard deviations are different with now since both of these have, if we go back to this slide, both of these have different expected or mean returns, which means they're not really comparable by standard deviation, although it could give us information that of level of dispersion. Since they have different returns and different, we could say average returns as shown here, 10 and 5%, they're not 100% comparable. So we could use the correlation or correlation coefficient to make them comparable. Okay, so if we're looking at a portfolio here and we want to invest in, what if we took 40% stocks and 60% bonds? So if we put those together, we're going to have a different expected return, which is going to be a weighted average of those two, and we're going to have a different standard deviation. So here we have a standard deviation of 8 and 18, and now by combining these two assets, we can have a lower standard deviation of 6, which would suggest that there's less risk and higher return than the bond portfolio, but lower return than the stock portfolio. So if you're willing to trade some risk for some return, this might be a more stable portfolio. So if we look at the covariance, we can measure the correlation coefficient, which means that we're just going to take the covariance divided by the standard deviation of stocks and bonds to get this correlation coefficient, so we can see how they correlate to each other. And we see they have a negative correlation, which means that often, more times than not, when stocks increase, bonds decrease. And when bond and stocks decrease, in return, bonds increase. And that's what builds a more well-diversified portfolio with lower risk. So if we're going to look at asset allocation, so including different allocations of different types of investment in your portfolio, stocks, bonds, international stocks, money markets, this real estate, this is what we call asset allocation. So if we're looking at two risky assets, how does this help? So we want to look at the variability of change over time on these two assets. To try to realize the return estimate, we cannot estimate averages precisely, but we can focus on the deviations of returns to calculate average return. So there are some formulas we have here that would help us to calculate the weighted average of returns of the components within the investment and the weighted average of expected returns on components and the variance. So, okay. And again, these are best calculated or are reviewed in a spreadsheet, not in the PowerPoint slide. Now, there is this risk-return trade-off that we're looking to measure or think about. So the investment opportunity set, available portfolios with different risk-return combinations. So that would be our opportunity set. So the mean variance criterion is going to look at, these different sets of portfolios, hopefully to find one that's more valuable for investors. And again, this is something that will be done in a spreadsheet environment more effectively than on a PowerPoint slide. So here's a look at expected returns. So this is sort of a precursor to an efficient frontier. So if we have our expected returns plotted on the X and then the standard deviation plotted on the Y, we can see portfolios on this is the efficient frontier. So portfolios here, this is the minimum variance portfolio. But if we have a portfolio of bonds, completely bonds or completely stocks, they'll live on the efficient frontier, but measured by their return and their risk position. So by combining these two, we can create a set of portfolios along this efficient frontier. Think of these as many different dots, which would represent different mixes of stocks and bonds together to be the most efficient sets of those portfolios. A portfolio that would have a combination that would be less efficient would be plotted behind this blue line. So when we look at opportunity sets, various correlation coefficients, we can start plotting them onto this chart as well to get an idea of how they would lay out against each other. Now here's another aspect of the correlation coefficients as we could calculate it within a spreadsheet, which I will upload to our website later. Now, the Sharpe ratio, we could look at a scope of CAL, and that is the Sharpe ratio of risky portfolio. So we have this simplified formula here that we could look at how to calculate that. So we're always trying to find the most optimal portfolio, one that's going to give us the highest amount of return for the lowest risk. So keep that in mind. So in talking about optimal risky portfolio with a risk-free asset, we can expand the asset allocation that we've been talking about to include a risk-free asset. So we're choosing a capital allocation between risky and risk-free portfolios. Investors naturally want to work with the risky portfolio that offers the greatest reward for assuming that risk. So we can see that in a portfolio with the highest risk to volatility, or the Sharpe ratio, as we talked about last chapter, the higher the Sharpe ratio, the greater the expected return corresponding to any level of volatility. So the next step would be to construct, the construction of a risky portfolio that can combine the major asset classes, which we think of as stocks and bonds, to provide the highest possible Sharpe ratio, because the higher the Sharpe ratio, the better. So, this again is, hold on, oops, let me just get back to, okay, this is how we could calculate that. It's a scary big calculation, but again, much easily done in Excel, and it's just a lot of variables, nothing too mathematically complex here. But what we're trying to do is the two capital allocation lines, we could look at, this is the capital allocation lines, we can look at these two, and then we can kind of plot that against the efficient frontier, which we discussed previously. And this can give us a little additional insights. So we can, so it's drawn through to show the risk return trade-off of various positions in treasury bills in the portfolio minimum. So it's immediately evident that from the figure on the slide that we could do better. So the higher the Sharpe ratio by using portfolio A instead of the minimum as the risky portfolio, the Cal dominates Cal A, which is here, is going to dominate over the Cal Min. So it's the sense that offers a higher expected return for any level of volatility. So the scope of the Cal corresponding to the risky portfolio P, which we saw over here in the previous slide, the Sharpe ratio of that portfolio, it is the ratio that's expected to exceed the returns of a standard deviation. So let's see. Let's just advance the slide here. And this is just some more application of stocks, bonds, and treasury bills and optimal allocation. That it takes a little interpretation to look at, but it's an important aspect of understanding how the Sharpe ratio is going to affect the optimal risky portfolio and the mix of treasury bills in general to bonds and stocks, in this portfolio. Okay. So remember in last chapter we talked about the preferred complete portfolio formed from a risky portfolio and a risk-free asset depending on risk aversion. So the more risk averse an investor is, they prefer lower risk portfolios despite the lower expected returns. While more risk tolerant investors would choose higher risk, higher return portfolios. So both types of investors, however, would choose portfolio O here on the slide as the risky portfolio, as it provides the highest return per unit of risk. So it's the steepest capital allocation line. So investors will differ only with their allocation of investment funds between portfolio O and the risk-free asset. So it's just giving you sort of a perspective of it. So here's a graphic of the asset allocation solution. So the solution is what percentage of the portfolio should be stocks and bonds, what percent would be treasury bills. And that's sort of what we're trying to uncover, is that mix of the bond fund and stock funds. So the weight's going to be about 55%, and about 45% is going to be the rest of the allocation of treasury bills. Okay. So the efficient frontier of many risky assets. So here is we can look at the graphic here, but we want to try to get a sense of, so if we look at, let me just see. So this is going to represent the portfolio's expected returns at each level of risk. So the three methods: maximize risk premium for any level of standard deviation, minimize standard deviations for any level of risk premium, and maximize the Sharpe ratio for any standard deviations or risk premium. So I know, you hear all these words, what does that mean? Let's just look at this graphically a little bit. So just to give us a better sense of how additional risky assets can improve an investment opportunity. So let's look at point A down here, point A, point B, and point C. So they represent the expected returns and standard deviations of these three stocks. So A, B, and C are stocks. The curve passing through A and B, so this is this curve here, passing through this line here, passing through A and B, shows the risk-return combination of these portfolios formed of different percentages of these two stocks. This could be 90-10, 80-20, 50-50, 20-80. So the curve passing through B and C, this would be the separate curve here, is through B and C, shows portfolios formed of these, or the combination of these two stocks. So now observe point E on the AB curve. So let's go, so this point E here is what we're talking about now. Endpoint F here on the BC curve. So these points represent two portfolios chosen from sets AB and BC combinations. So the curve that passes through E and F in turn represent portfolios constructed from portfolios E and F. Since E and F are themselves constructed for A, B, and C, so And keep in mind, so this is that black curve. This is all the portfolios we're putting E and F together, which is constructed from A, B, C. That curve, this curve is going to show, this black curve here is going to show some of the portfolios constructed from A, B, and C. So notice that the curve in EF extends the investment opportunities to the northwest, which is the desired direction of the efficient frontier. So this is the efficient frontier, which would be the highest return for the lowest amount of risk. So now we can continue to take other points, each representing different portfolios from these three curves, to further combine them into new portfolios and shifting the opportunity set even further northwest, which is the direction we want to go in. So you can see that this process would work even better with more stocks. However, the boundary envelope we're developing on these curves will lie quite away from the individual stocks as we pull that direction more northwestern as we're adding more stocks. So this analytical technique is, of course, something I was discussing earlier from the modern portfolio theory or that Markowitz model. And so we want to determine this risk return opportunity set and place it on some kind of graphical map. And this is what the efficient frontier is that I was talking about earlier. So as you're reading this chapter, you'll go into more depths of explanation of, the input, which are basically the expected return, standard deviation of each asset in the collection of assets, along with the correlation coefficients between each of the pairs of assets. So this efficient frontier is the graph that's going to connect these dots, and then the dots on the most northern, westernmost of the portfolio is what is the efficient frontier of the risky assets. Okay. So this is sort of a better graphical representation of what I've been saying. So here, all these individual stocks, but the stocks that lay on this curve out here is the efficient frontier of the risky assets. So any point here would be the most return you would get for the expected standard deviation or risk in the portfolio. Okay. Now, choosing optimal risky portfolio is sort of the next step. So if you're trying to optimize and you want to involve a risk-free asset, using the risk-free rate, we can search for this capital allocation line with the highest Sharpe ratio, which basically means the steepest slope. So the capital allocation line forms from the optimal risky portfolio, and previously what we saw in O, and that will be a tangent to the efficient frontiers of risky assets discussed that we were discussing before. So, let's see, determining the optimal portfolio. So determine the optimal risky portfolio through this method, and then two, personal choice, the best mix of risky portfolio and risk-free assets. So this would really be, when it says personal, you need to make the decision of how and what you would want to put together. Okay. So let me just see here. Here's sort of an illustration. Let's see here. It's just looking ahead for a second. So here is the illustration of efficient frontiers that we can kind of look at here. So here we have the efficient frontier, the capital allocation line, the efficient frontier with no short cells. So you see these different indicators, min variance, max. Okay, so this is involving some short cell in here. So let's just go back to this previous page. So optimal risky portfolios, how they're constructed. So suppose an analyst wanted to construct an efficient, diversified global portfolio using stock indexes from 6 different countries. So they could use the values of standard deviations and the correlation matrix to estimate from historical data and forecast the risk premiums generated from the fundamental analysis. So that's basically what we're trying to do here. And some things that we want to think about as we're putting this together in the, a single index stock market is, trying to make a distinction between systematic and firm specific risk. Systematic risk, as we talked about earlier in the chapter, we know that it's something that we can't easily escape from. So it's going to affect, this index model in a way that, it's designed to estimate these two components of risk, systematic and unsystematic, for any particular security in the portfolio. Now, so the relative stock returns to the broad market is what we're looking at. So excess returns in excess of the risk-free rate is something that we want. And beta, as we talked about earlier, measures the sensitivity of returns to that market or the stock market. So we could use these indicators to help fine-tune our portfolio construction. And here's the formula how to calculate the excess return. Okay, so we have this couple of the formulas here, and these formulas are going to help create just another application of how to statistically interpret these different characteristics. Okay, so what we call the security characteristics line, this is going to tell us on average if one particular stock rises, say, by 2% for every additional 1% return in the market, we're going to put this value together as a residual, which should be set to 0. So investors naturally will be attracted to stocks with positive values of alpha, as positive values imply higher average returns or average excess returns without the cost of any additional exposure to market risk. So that would be a good thing. Okay. Now, so you can see how this chapter has a lot of complexity in it and a lot of mathematics in creating these regressions and plotting these characteristics. Here are some of the other formulas. But what we're basically trying to do here is if we were to scatter plot, utilize these statistics and plot them on scales, we have a better idea graphically of how we can use, say, a scatter design diagram to get a feel for where our stocks would lie in overall risk. Okay, so I'm going to end this here, and we'll continue with the Excel video. We're going to show some of the mathematical work in this chapter in Excel. Okay, I look forward to talking to you then. Take care.